Microeconomics Theory and Applications with Calculus, Jeffrey Perloff, 2nd edition. Chapter 2.5, Elasticities. It is convenient to be able to summarize the responsiveness of one variable to a change in another variable using a summary statistic. In our last example, we wanted to know whether an increase in the price of a product causes a large or a small change in the quantity demanded. That is, whether the demand curve is relatively vertical or relatively horizontal at the current price. We can use summary statistics of the responsiveness of the quantity demanded and the quantity supplied to determine comparative statics properties of the equilibrium. Often we have reasonable estimates of these summary statistics and can use them to predict what will happen to the equilibrium in a market, that is, to make comparative statics predictions. Later in this chapter, we will examine how the government can use these summary measures to predict how a tax on a product will affect the equilibrium price and quantity, and hence firms' revenues and the government's tax receipts. Suppose that a variable z, for example, the quantity demanded or the quantity supplied, is a function of a variable x, say the price of z, and possibly other variables such as y. Z equals f of x and y. For example, f could be the demand function, where z is the quantity demanded, x is the price, and y is income. We want a summary statistic that describes how much z changes as x changes, holding y constant, and elasticity is the percentage change in one variable, here z, in response to a given percentage change in another variable, here y, holding other relevant variables, here y constant. The elasticity, capital E, of z with respect to x is E. Let me say again, capital E equals percentage change in z over percentage change in x, which equals delta z over delta d over d equals italics dz over italics dx multiplied by x over z, equation 2.20, where delta z is the change in z, so delta z over z is the percentage change in z. If z changes by 3% when x changes by 1%, then the elasticity, capital E, is 3. Thus, the elasticity is a pure number. It has no units of measure. Superscript 11. It reads, economists use the elasticity rather than the slope, italics dz over italics dx, as a summary statistic because the elasticity is a pure number, whereas the slope depends on the units of measurement. For example, if x is a price measured in pennies and we switch to measuring a price using dollars, the slope changes but the elasticity remains the same. As delta x goes to 0, delta z over delta x goes to the partial derivative, italics d z over italics dx. Economists usually calculate elasticities at this limit, that is, for infinitesimal changes in x.